Thanks for joining us. Let's turn to the agenda for today. You'll see we've kind of combined in a little bit of a newer format, the economic and investment outlook in this, what I'm calling just some high points, which really correspond to each of the slides on this presentation. Okay, so let's get to the topic at hand. You may notice that I've changed the picture. Was a bit more of a choppy waters theme coming into first half. Clearly, we still believe that's the case to some degree, but I think the waters definitely after H1 have simmered down a little bit. And we'll talk about how we're positioning for this slight modification of volatility. Before we do that, I just want to take a look at economic indicators, a few of them, because economic conditions and volatility definitely frame financial assets and prices and their volatility correspondingly. So, this picture is probably a pretty familiar one for those that have been on for a number of sessions. And what it's showing is the two broad categories of the U.S. economy. One is the ISM services or services index in purple. The other is the manufacturing sector, U.S. manufacturing sector in orange. And again, trends that have been in place remain in place, although I would say resilience in the services sector is really starting to show up as we're bouncing along the contraction line. That's what that dashed line is. Any number above 50 is expansion. Any number below 50 is contraction. Services being the largest component of the economy, roughly 80% of the U.S. economy is services. So the purple line has a bit more meaning to it than the orange one does. In any case, what you're seeing here, I think, is just a picture of maybe what everyone's feeling a little bit, and that is some choppiness within certain sectors of the economy, but by and large, the U.S. continues to grow at a pretty decent clip. And so we certainly want to be mindful of that and as it relates to any adjustments we might be looking to make, because forecasting a recession is certainly something that we'll put some idea and thought into, but not something that we feel is imminent. I did just want to point out here, I pointed this out on one of the 2 Minutes podcasts in June, but what you see here is a summary of the Federal Reserve board members' expectations for where the Fed funds rate is going to be. Those are those dots here, so that each dot corresponding to where each of the Fed governors right now believe the Fed funds rate is going to be at the end of 2024, end of 2025, and the longer run. And 23, you can see here, now this was as of the June projections, which I believe was in June 13th. But you can nonetheless, rates are pretty consistent around these levels. And so you can see I've plotted on top of that with a star where the market believes the short-term one-year bond rate is going to be, which is a rough proxy for the Fed funds rate. And you can see there's some pretty decent consensus around between the market and the Fed for the end of 23, that this makes sense because we're pretty close to the end of the year in relative terms, 5 months away now. 24, it becomes a little bit more of a disparate picture here, where you've got some people thinking that Fed funds rate's still going to be pretty high to tame in inflation, and then below must be just some folks thinking that we might have hit already some economic choppiness that would create a need to cut rates. 2025, however, is really where I want to spend some time, because what this picture just shows you is that there is not any consensus at all among the Fed governors as to where the Fed funds rate is going to be. And that kind of makes sense because we are still in the midst of a transition phase for the economy. And I think by and large, what that frames for us is that, taking on any long duration bond risk or buying bonds that are maybe longer than 5 years still does not make a lot of sense at this juncture, because there are such wide ranges of outcomes that could occur that, if rates were to move a lot higher from here, then obviously those bonds would get punished pretty mightily with the price depreciation. The other thing I would just point out here is this quote unquote longer run expectation. This is the 5 years and out. And the reason I wanted to show this, and you'll see on another slide, is that the market still believes that the Fed will be able to rein in inflation to a target range of, now 2 to 3%. So that I think is really important, because market is still very much in line with the Fed, and the confidence hasn't been lost. turning our attention again to where we are within the yield curve itself. And what you're seeing here are two ratios. One is the difference between the 10-year bond and the 2-year bond in the purple line, meaning that the difference in yield. If it's positive, that means that the 10-year bond is yielding a higher level than the 2-year bond. And if it's negative, like it is right now at negative 88 basis points, that means that the 2-year bond is yielding higher than the 10-year bond. Same thing with the 3-month 10-year. Very similar, but also different to some degree. And the reason I wanted to just point this out is because what we'll be looking for next. So when the yield curve is inverted, the next thing that you want to look for once it's stayed inverted for a little period of time, 1 to 2 months, is what they call a re-steepening of the yield curve. So that would mean that we'd be looking for next these lines to start turning upward in a pretty meaningful way, and decidedly meaningful over time. And that would, I think, be the signal that we are a lot closer to this recession than maybe the market expects at the moment. So a re-steepening is what we're looking for. We haven't quite seen that yet. There have been some upward ticks in some of these ratios, but right now it's still a lot of noise. So we have to be mindful of that. But I just wanted to point that out. Turning to our portfolio themes, certainly the icons haven't changed, but I did change a lot of the text here. So bear with me because this is more or less a second half outlook to some degree. Yeah, there's still, I think, remains, as I pointed out in the bond market, a big expectations gap. And then financial prices are priced off of interest rates, generally speaking. So it's really important that we be mindful of what interest rate markets are doing. And as I've just pointed out, there's still quite a bit of dissonance in the interest rate expectations that we lends itself to some conservatism, at least not necessarily on the equity side, but in other markets that might be more impacted. Still a little bit of no man's land, in my opinion. The fact that commodities and other assets have not performed well at all during this first half, whereas technology has had a really sizable performance in the first half, just indicates that we could be a big rotation, could be on the horizon, and that we need to be mindful of things that haven't necessarily performed so well in the first half versus technology positions. So still very much in no man's land, in our opinion, despite the fact that the equity market is up, call it 16% year to date through June 30th. There are opportunities on the horizons. We have actioned in many portfolios, adding REITs to a majority of our portfolios, either single stock positions that are REITs or index positions. And I think this is just one good example of if we remain patient, those opportunities will come to us. And if we have a framework for identifying those, then I think our odds just get a lot better as to entry point. We talked about this already a little bit. They both can't be right, the Fed and the markets, because they're telling different stories right now. This is our updated investment ratings slide. You can see there is a little bit of a bias to a more attractive level where we're adding to things for the first time in a while. Still on the US side, we've got a preference for mid-cap, select parts of large cap, maybe even some small cap companies to some degree. But equities, even though they've had a great start, it's been a very disparate picture. And some of the parts of those markets have not performed well at all relative to the S&P. So that's why we still maintain these ratings. Developed markets still look relatively attractive from a valuation standpoint. We'll touch on that in just a moment. Still have no emerging market exposure. Short-term bonds are really where we're focusing a lot of effort. I would say also on the municipal side, those are getting more attractive as the short end of the yield curve continues to move higher as the Fed raises rates. And that's where we've found a lot of interesting opportunities. And as well, I would say, even though we don't have any exposure to preferred stock, junk bonds, or emerging market debt, our fixed income portfolios have performed in line with all these asset classes because we've been pretty mindful of our positioning and gotten some of those calls right. And then just still want to highlight here that relative to some parts of the bond market, for sure, liquid and private alternatives make a lot of sense right here. And as I just mentioned, we added REITs in June across the board to model accounts. Wanted to highlight here that we do find ourselves, in my opinion, in a momentum-driven market. Momentum meaning there's a lot of performance chasing going on and trend following, driving flows into certain parts of the market. Clearly, a lot of the capital has been flowing into large cap technology. That's referenced by this Russell 1000 Growth Index here, almost an unbelievable 29% through the first half of the year. You can see the S&P here up 16. But I think even more importantly is that the value index, Russell 1000 value index, is only up 4. Now, that was actually negative when we met last time. And so really important to be mindful of this, because, one of the reasons that value stocks could be really interesting here is that big parts of the value index are financials, even healthcare. Both of those have been weighed down by, I would say, issues from, maybe last year with the yield curve in particular for financials. Now that the short-term income is at a much higher level, as JP Morgan's report today points out, maybe that's an opportunity to, be a little bit more aggressive on the financial side. But we haven't made any big shifts in that way quite yet. Just as another depiction of that chart previously, if it's even more concentrated, unfortunately, than appears from that chart, because if you were to break down the composition of return for the S&P through June 30th, what you'll see is 8 stocks comprised, call it 90% of the return here. 11% of the return out of a 13. Now this is not a total return index. That's why that doesn't match with the 15.9. But nonetheless, 8 companies listed right here comprised roughly 80 to 90% of the return for the S&P. And that's the definition of a concentrated market. And we would be looking for that to reverse a little bit and pull in broader participation. Because if broader participation doesn't happen and these companies continue to pull the market higher, that would be a pretty clear signal that we would be in for some trouble ahead. We're not quite there yet, but it's just on our minds. Kind of the next iteration here, I was talking about momentum absolutely taking over. This is a valuation picture. So on the left-hand side here, you can see the price to earnings ratio based on what companies are expected to earn over the next 12 months. So it's the PE ratio, just 1 year in the future. And you can see, unbelievably, the S&P is now, at the beginning of the year, started off life at a fairly reasonable valuation, call it 16.9, 17%. There are 17 times earnings that went higher after Q1, but now we're over 20 times earnings for the S&P. And that, again, if you look at what's happened when the S&P has reached 20 times earnings, it's generally low single-digit returns, if not negative, for the following 1 to 3 year time frame. Russell 1000 Growth Index, again, kind of approaching this, 30-ish level, which is exceptionally high relative to a lot of other different asset categories you could own. Small cap, this is a little misleading only because this Russell 2000 index has a larger component of financials. The earnings have been a little bit more under pressure on the small cap bank side than large cap. So that's, pulling the E number down on the PE ratio, thus making the ratio higher. But selectively, I think there are some interesting opportunities there on small cap. Mid cap, as you may recall, we've had a preference for some time that hasn't necessarily worked in our favor up to this point. Large cap tech, as I was just mentioning, has been the main beneficiary of market movements so far. But you can see here, I think from a valuation standpoint, the starting point on mid-cap companies is a lot better right now than the S&P. And certainly, I think that's framing some opportunity sets for us. And then from an emerging market and developed market standpoint, this is one of the reasons why I just don't see a big reason to go into emerging markets quite yet. Because if you're going to go international, you're paying essentially the same valuation level for developed companies in Europe and Japan versus emerging market countries that have higher levels of political and property rights risk. So why even bother? But again, a pretty significant discount to the US that, by the way, they've always traded at a discount to the US. But when it reaches levels we haven't seen for some time, that's when opportunities get a lot more attractive. We haven't made any asset allocation shifts there yet. We still have a target weighting to our international positions of roughly 15% of our equity exposure. And we'll likely probably not change that a whole lot in the near term, but certainly if these different valuation levels widen out, then I think that would be a catalyst for a shift higher and international developed incrementally. Just wanted to point this out. I think I covered this in the last or one of the 2 minutes indexes or updates, but we went ahead and created a office, what I'm calling the Gratus Office REIT Index. See the disclosures for how that's constructed. But basically, it's taking the top 10 office REIT indexes because that is the locus of all the pain right now in real estate. For the most part, apartments have been pretty well performing. Industrial has performed pretty decently as well too. So really, the big negative for REITs has been the office sector. You can see that pretty clearly here. Office was at one point down 30% for the year entering June. Remember, we in Market Matters that was on June 5th, we highlighted that REITs were getting attractive, and we added them shortly thereafter. And that appears to be a pretty well-timed movement or adjustment because REITs have recovered, call it roughly 15, maybe 20% of the value that they had originally lost going into June. So not to say that the position is up 20%, but more, this is definitely a positive position for us at the moment. And more importantly, because we waited to buy the broad, REIT index, the yield at the starting point was a lot more attractive than it was or would have been 2 years ago or something like that. Turning to the bond market, we touched on this a little bit. This is the picture of what an inverted yield curve means. So, and you can see this is what yields were like for each of these maturities, 1 month, 2 month, 3 month, 1 year, 2 year, 3 year, all the way out to 30 year. And at different points in time. So the light blue line was July of last year. This is July of this year. I mean, this is how much progress has been made within the rate hiking cycle or program that the Fed implemented in March of last year since that point. So a significant amount of financial tightening has occurred. And you can see where, the Fed, where the yield curve sits right now since the beginning of the year. So the beginning of the year level was the green line here. We were very cautious on the yield curve at the beginning of the year as well, and that seems to be pretty well rewarded at the moment. But the 2-year bond or 1-year bond is right hovering around 5, between 5 and 5.25. 2-year bond is just a hair under 5%, and then most of the short end is above 5. Whereas the long end, interestingly, is actually come down a little bit in yield, not much, but down a little bit in yield since the beginning of the year on the 30-year side. But the byproduct of this yield curve on the long end having risen so much from where it was, a year ago or 2 years ago, is that now the average mortgage rate, I was just seeing the other day from LendingTree, is right at almost 7%. So, so effects being felt, across the curve, and just wanted to reiterate, we still continue to find a lot of attractive opportunities, right in the 1 and 2 year box. Commodities, this is something that's been bothering us for a little bit of time, or bothering me in particular, is that this is a picture of commodity prices that I showed the investment committee every quarter, but I thought I would share this just to give everyone an idea of what commodity prices have done in broad strokes. So the purple line is energy prices. So that's a combination of crude, diesel, natural gas. You can see down 13% for the year. I think, really what's driven this down primarily has been the fact that the China reopening that was supposed to happen towards the beginning of this year never really materialized at the pace the market had expected. And the market had built up some speculative positions on the long side that needed to come out. We do seem to be finding a very solid footing though here in energy prices. Call it around $67 to $70 a barrel for crude oil, $2.50 on natural gas. And so I think that's actually telling us that there could be some firmness in prices, and that there might be some upside in the future. The only commodities that are up for the year are agricultural, though this is actually, corn, wheat, soybeans, canola oil, that type of stuff. And, I think the problem with energy or food prices being up as much as they are, or moving higher, is that just, and we all have seen the consumer price index evolution. Headline is now down to 3% year over year, which is great. Core CPI, though, is still above, call it 4, 4.5. And what our fear is here is that agricultural commodities could be a catalyst for higher inflation, or at least stickier inflation that previously wasn't much of a concern. So we'll have to keep a close eye on that. And then the base metals, this is things like copper, tin, zinc, aluminum, steel. You can see how those prices have evolved down around 7% for the year. This is copper. You may have heard the term Dr. Copper is the best predictor of the economy, because industrial demand for commodities tends to be coincident with growth. And if commodities are being, are in less demand than they were at this point last year, surely that has to translate into potentially some weaker growth on the horizon. We'll be watching, again, commodity prices, but I just wanted to share with everybody some thoughts on commodities, because it can be another one of those useful indicators to keep an eye on. Here we are, said some of the key takeaways. Rally in 23, as I mentioned last month, continues to be, in my opinion, rooted in capital flows, which is much more momentum driven than fundamentals. That's not a big deal as long as we recognize that. Again, not too dissimilar to what happened in the 98, 99, 2000 timeframe. Global stock markets, though, will need to take a breather in our opinion. We just got earnings season for Q2 kicked off this week. Next week will be much more meaningful with earnings reports. And we'll just have to see how companies have adapted to some of the inflationary pulses that are still, around, but also getting a better sense during those reports from consumer demand, because that's really where the rubber is going to meet the road, is in consumer demand. If consumer starts to soften with spending pattern and activity, that will definitely translate into weaker services growth, which by extension could push us into a lower growth regime. But we'll have to wait and see. Alternative strategies still over bonds. Yes, the short end is representing an attractive point. But the problem with the short end being attractive is that those yields could be gone in 6 to 9 to 12 months, and really we're looking for ways to generate a durable return that doesn't have a lot to do with stocks and bonds. And actually, by the way, a lot of the alternative strategies that we have in place on the liquid side benefit from higher short-term rates. So that's still why we are going to be probably having a slight overweight to alternative strategies over bonds. But that could change if the 5-year bond gets to 5%. That's kind of our bogey for flipping back to a more heavier allocation or weight to bonds. And then private markets are, again, starting to price in discounts or opportunities to get more aggressive. Certainly those opportunities are just starting to happen, because pricing in private markets tends to operate with a substantial lag. So we'll need to be patient there, particularly in things like private real estate or private equity. But just for reference, the venture capital or growth parts of the private markets are now showing some secondary transactions, meaning people are buying interest from other LPs at really substantially discounted prices right now. So think 40 to 50% down from where transactions previously occurred. That's a pretty decent starting point. So we just wanted to make sure we pointed that out, that there will be a time to get more aggressive, particularly in private markets, but that's just starting to happen. So we're being judicious about that exposure. Thank you for joining us today. I know Friday in July can be a difficult window for everybody, but appreciate those that tuned in. We look forward to speaking to you again next month, and have a great rest of your afternoon.